my fellow students. Have a nice day. In the course Capital Market, we are now already in chapter 14. In this chapter, we will be going to discuss about the term structure of interest rates. This topic composed of four subtopics, namely the yield curve and future interest rates that will be discussed by yours truly. And the third one is interest rates that will be discussed by Kuya Alden Casalhay. And last topic would be about theories of the structure that will be discussed by Ate Helen Mokor. In this chapter, we will explore the pattern of interest rates for different term assets. We attempt to identify the factors that account for that pattern and determine what information may be derived from an analysis of so-called term structure of interest rates. And we will be able to know also the extent to which the term structure reveals market consensus forecast of future interest rates and how the presence of interest rate risk may affect those inference. So, here we go. Interest rate or required return represents the price of money. This is the compensation that a demander of funds must pay to a supplier. For example, if A owe money from B worth of 5,000 pesos and promise to pay in 2 years with an interest rate of 3%. So the 3% there are the interest rate of the total amount of money borrowed from the lender. Next, we will now go to the term structure of interest rates. Term structure interest rate is the relationship between the remaining time to maturity and the yield to maturity of a bond. Time to maturity is the life of holding period of a bond, while the yield to maturity is the expected return on a bond. Whereas the yield curve is a type of plot or graph that represents the relationship between the remaining time to maturity and the yield to maturity of a bond at a given period in time. It is expressed as a percentage based on the investment amount, current market value, or face value of a specific security. The flash pictures are the types of yield curve. In panel A is the almost flat yield curve in early 2006. It happens when all maturities have similar yields. In panel B is more typical upward sloping yield curve or normal yield curve from 2012. That's when a long-term interest rate is higher than a short-term interest rate. Example is when you lend your money for a longer period of time, you expect to earn a higher compensation for that. Another is panel C. Panel C is a downward sloping curve or inverted curve. That's when a long-term interest rate is lower than short-term interest rate. And the last one is panel D. Panel D is a hump-shaped yield curve, first rising and then falling. A hump yield curve occurs when medium-term yields are greater than both short-term yields and long-term yields. It is rare and typically indicates a slowing of economic growth. Next, we'll go to band pricing. When we say band pricing, from the word itself, it is the evaluation of a specific price of a specific band. Determining the price value of each band is very important. But how are we going to know this price? In giving price to every band is not that easy because just like goods, bands have its own pricings that should be followed. We can value a band as much as we want as long as it follows the rule of giving its value and it was sold as a standalone zero coupon band. That's all that matters. When we say zero coupon bonds are bonds that do not pay interest during the life of the bonds. Investors usually buy a zero coupon bonds in strips market and strip it into two and sell its other parts with different maturities and different price. Both band stripping and band reconstitution offers opportunities to a band to avoid from possible risk. Now let's move on to in how to solve for a band's price or solving for a band's price. So in solving for a band's price, I'll show you a sample problem. So let's solve this. Okay, assume that we have a band that matures in 3 years. The band's face value is 1,000 and place a 7,000 annual coupon interest rate. The yield to maturity in this band is 8.5%. So the question is, what is the current price of the band? Firstly, what we need to solve for is the annual coupon interest rate that the bond holder will get, and that would be calculated as this. Annual interest payment is equals to annual coupon interest rate times band's face value. So based on the problem, our annual coupon interest rate is 7%. So we need to convert it into decimal points, so it will become 0.07 times the band's face value, which is 1,000. So therefore 0.07 times 1,000 is equal to 70. Therefore, the bond holder will get a 70 pesos of interest income a year for the next 3 years until the bond comes into mature. So after getting the annual coupon interest rate, we will now proceed to getting the price of a specific band. So as you can see, we repeated the coupon interest rate 3 times. It's because the band matures 3 years. So it will be goes like this. Coupon interest rate plus a coupon interest rate divided by yield to maturity plus coupon interest rate for the second year divided by yield to maturity, and for the last term another coupon interest rate including the band's face value divided by yield to maturity. So let's now substitute its amount based on the kanang problem. So our coupon interest rate is 70. Our yield to maturity is 1.85, and this and same with on the second year. 70 divided by the yield to maturity which is 1.085 raised to the power of 2. It's because it's for the second year of a band. And next is another 70 plus the band's fixed value, which is 1,000. So it will become 1,070 divided by 1.85 raised to the power of 3. So 70 divided by 1.85 is 64.52. 70 divided by 1.85 raised to the power of 2 is 59.46. And 70 plus 1000 is 1070 divided by 1.85 raised to the power of 3 is 837.71. 64.52 plus 59.46 plus 837.71 is 961.69, and that would be the price of the band. Another subtopic of this chapter is the yield curve and future interest rates. This time we will discuss about why is it the curve changes its slope from time to time, and if how to determine the current rates of a band as of today or in the future. We will begin with the yield curve under certainty, meaning the investors already know the path of future interest rates of a specific band. If the investors notice the upward sloping yield curve, it is an indicator that short-term rates are going to be higher next year than they are now. We have 2-year band strategies. The first one entails buying 2-year zero offering a 2-year yield to maturity of 6% and holding it until maturity. And the second one, invest the same amount of 890 in a year zero coupon band with a yield to maturity of 5%. When that band matures, reinvest the proceeds in another 1-year band. If we will shows it in a plot, this is how it looks. Next, holding period returns. Suppose that you bought a 2-year band for 1 year, and you will be written like this: 1,000 divided by 1.06 raised to the power of 2. 2, it's because it matures in 2 years. Why is it 1.06? It's because 6% converted into a decimal point, it will become 0.06. The 1%, it is the face value of the band, so it will become 1.06. So that's it. So if we computed 1000 divided by 1.06 raised to the power of 2, the answer would be 890. Next year, the band will have a remaining maturity of 1 year. So since 2 year man siya, so napanabili na 1 year. And the 1 year interest rate will be 7.01%. Therefore, in the price next year will be written as this: 1000 divided by 1.071. Again, why is it 1.071? Because the yield to maturity of a band for the next second year is 7.01%. If we will convert it into decimal point, it will become 0.0701 and included the face value of a band, which is 1000. That's why it's become 1.0701. So if we will be computed 1000 divided by 1.0701, it will become 934.49. So to get the holding period returns, we will just subtract the two. First is 934.49 minus 890 divided by 890. That answer would be 0.05 or 5%.